Hello, and welcome to the Webcast FASB update for private companies and not-for-profit organization. Thank you for being with us today. Please note that the views expressed in this webcast are those of the individual presenters. Official positions of the FASB are reached only after extensive due process and deliberations. Next slide. My name is Jennifer Weiss. I'm a supervising project manager and coordinator of the Private Company Council, or the PCC, and the Not-for-Profit Advisory Committee. Presenters on this webcast include FASB Vice Chair Hillary Salo, FASB member and liaison to the PCC, Sue Cosper, PCC member Michael Chang, Jeff Mechanic, FASB Senior Project Advisor, Jeff Gabello, FASB Supervising Project Manager, and two FASB Postgraduate Technical Assistants, Rose Hartnett and Lucas Rich. There are a few housekeeping items to go through starting on the next slide. First, webcast slides are available on the FASB's website by clicking on Educational Webinars under the News and Meetings webpage. Next, to ask a question, type into the Q&A box and click Send. We will do our best to respond to questions throughout this webcast. However, for those questions that we aren't able to get to today, we do have a free technical inquiry service on the FASB's website where you can submit technical accounting questions. Playback of this webcast will be made available for 6 months. However, we cannot provide CPE credit to those who watch the archive. Next slide. Up to 2.5 hours of CPE credit is available for viewing the live program. CPE credit will not be awarded for group viewing. CPE credit is expected to be awarded within 14 days if the following requirements are met. 8 of the 10 polling questions must be answered. We ask that you stay on the webcast for the required number of minutes and that you complete the course evaluation at the end of this program. Next slide. So what's on the agenda today? Hillary's going to kick us off by providing an overview of the FASB's agenda and the 2024 agenda consultation. Mike is then going to talk about the Private Company Council, its agenda priority process, and other PCC activities. Then moving into post-implementation review, Sue will provide an overview of the PIR process, and Sue and Mike will talk about some of the recent FASB and PCC post-implementation activities associated with revenue, leases, and credit losses. And then Jeff M. will talk about recent discussions by the Not-for-Profit Advisory Committee, or the NAC, and then several of us will highlight certain FASB technical agenda projects and research projects. Before we move into our first topic, however, we will launch our first polling question. And that polling question asks, did you participate in our June 2024 webcast FASB update for private companies and not-for-profit organizations? A, yes, B, no, C, not sure. So as we're waiting on responses, there is a PCC meeting that's coming up next week. Day 1 of the PCC public meeting starts around 3:15 p.m. Eastern Time on Monday, December 16th. And during day 1, the PCC is expected to discuss accounting for government grants, accounting for and disclosure of intangible assets, and financial key performance indicators for business entities. Day 2 of the PCC public meeting is on Tuesday, December 17th. That meeting starts at 8:30 Eastern and will conclude around lunchtime. During day 2, PCC members will discuss their agenda priorities, debt modifications and extinguishments, leases, credit losses, presentation of contract assets and contract liabilities for construction contractors, and a town hall liaison meeting update. PCC meetings, they can be viewed live on the FASB's website. If you're unable to view it live, then a playback will also be available. Materials will be available on the FASB's website prior to the start of the meeting. Okay, so with that, let's go ahead and close out the polling question and share those results. Fantastic. We have some folks that are returning attendees and also some new folks. So great. Thank you for that. So Hillary, I'm going to turn it over to you.
Great. And thank you, Jennifer. And And it's a real pleasure to be here today, and I'm really thrilled to have such a great turnout for this webcast. And as you just heard from Jennifer, there's going to be a lot of material that we cover today, and it's really primarily due to the extensive progress that we've really made on both our technical and our research agenda projects. So we thought it would make sense to first start with, before we get into the details on each of those projects, maybe give you a little bit more background with regards to how did our current agenda come to be, including how these topics really ended up on the FASB agenda and why they ended up on the FASB agenda. So if we move to our next slide, the projects on our agenda today, on our technical agenda and our research agenda, are really a direct result of our agenda consultation process that we completed in 2021. So really, when we embarked on that initiative, it was to do more than to just create a new lineup of projects. What we really wanted to do was give stakeholders that broader opportunity to really tell us what our priorities should be from a future direction perspective. Where and how should we focus our resources to really best meet and fulfill our mission? And so in order to do that, we did engage in a broad we talked with a broad range of stakeholders. It was about 200 stakeholders that we spoke with, as well as all of our advisory committees, before we even issued the invitation to comment in 2021. What we really wanted to do was get their initial thoughts on what were things that were, they thought should be priorities for us to take on, and kind of put that out for the public to be able to respond to. And I think given a really open nature of our invitation to comment, we did solicit quite a bit of feedback. We actually had over 500 different responses to our invitation to comment. So I do think that that was a successful effort of making sure we were reaching out to that broad base of stakeholders. And certainly I want to thank anyone who participated in that process, because that feedback was especially critical for us being able to comprehensively reset our agenda, as well as to really figure out achievable solutions to move our projects forward on the agenda. So if you move to the next slide, from that agenda consultation process, just to give you a little bit of a summary of kind of what we heard at that time, we really heard from especially investors and other financial statement users that they were really interested in us prioritizing projects that result in greater granularity and disaggregation of financial reporting information. They were interested in projects that would address emerging areas, such as, the accounting for digital assets and ESG-linked financial instruments. And then they were also interested in projects where the areas of guidance are really viewed to be those where there's maybe unnecessary cost and complexity in the system to be able to apply that guidance. And so what we did is we took that feedback, and you can see on this slide the feedback that were the top 7 topics from an investor priority standpoint. You can see that on this slide. And we kind of took that feedback in, and we've made significant progress on these topics. As you can see, we've completed standard setting on 3 of these topics, being digital assets, income tax disclosures, and disaggregation of income statement expenses. We've issued or we're going to issue exposure drafts or invitations to comment on 3 of these topics, including ESG-related transactions, intangible assets, and financial KPIs. And we're also considering the cash flow feedback that we received as part of both a project on our technical agenda and one on our research agenda as well. And so while these were top priorities from an investor or a financial statement user perspective, you can see on the next slide that a lot of these topics really were also highly rated by other stakeholder groups as well, including preparers and practitioners. And so this slide really just highlights some of those other areas that were focused areas for other stakeholder groups, including the modernization of the accounting for software costs, creating recognition and measurement guidance for government grants for business entities, and really more broadly considering the definition of a derivative, in addition to other sort of feedback that we received on our own internal processes, such as, are there improvements that can be made to the interpretive process, to the EITF process, as well as were there improvements that were able to be made with regards to the accessibility to the codification and improving the searchability of the codification. So we were able to take all of this feedback in, and as I said, really in 2022, we comprehensively reset our agenda. And since that point, what we've been doing is really focused on completing outreach with stakeholders to understand the benefits and the costs of the different approaches that we've been looking at for each of those different projects. And collectively, with the help of stakeholders and the great research and analysis that's put together by our staff, we've really been able to find productive paths forward on these projects. So if we move to our next slide, this is kind of where we stand today with regards to our technical agenda. So this gives you the comprehensive list of all of the projects that are currently on our technical agenda. And it also provides you an expectation of when our next milestone will be achieved. Now, if you're taking a look at this slide, it's going to be rather evident that over the last few months, we have issued a number of different documents from an exposure perspective, some of which we've already received comments on, and we thank everyone who's participated as part of that process, and others that we expect to receive comments on shortly. And we do have a few other documents that we are going to be issuing for comment by the end of the year or during the first quarter, so things to look out for. Now, we do understand that there are a number of different due process documents that are out for comment or will be out for comment shortly. And we have tried to stagger those comment letter due dates and increase the length of our normal comment letter period. In some cases, we've actually increased the length to over 5 months from a comment letter period perspective to really reduce the burden on stakeholders and to ensure that there's sufficient time for you to be able to provide thoughtful feedback as part of our process. But certainly, well, we don't expect all entities to provide feedback on each of the different projects that we have on our agenda. It's pretty rare that all of the topics would hit all of the different items and in industries that you work in. But we do really want to make sure that we receive your feedback. So I just want to be, clear as we want to make sure that you have the time to be able to provide us your feedback. So if that means if you're looking at these comment letter due dates and you think, I'd really love to send in a comment letter, but I just don't have the time or the resources to get it done by that comment letter due date, there's a couple of different options. One thing I would say is reach out to us. We are more than happy to connect you with our staff who could hear your feedback verbally, and then they would provide that feedback to the board as part of redeliberations. In addition, if it's timing issue and your comment letter, maybe a little bit after that due date, just let us know. We're absolutely taking all of the feedback that we receive before the board, begins its redeliberation process to make sure that we have all of that important feedback. So again, just let us know if we can be of any help to help support the process for receiving your feedback. Now, if we move to the next slide, this is really just to round out a discussion of our current agenda. This is the 7 different projects on our research agenda. So those include 3 projects that we're going to be issuing or have issued invitations to comment on, including the accounting for intangibles, financial key performance indicators, as well as our agenda consultation process. Now, one thing we talk about invitations to comment. Invitations to comment, right, they're very different than a due process document like an exposure draft where the board has voted on all of the decisions in those documents. Invitations to comment are really issued by the staff, right, at the direction of the FASB chair. And it's really to get your kind of preliminary feedback on, whether these are topics that should be addressed on the technical agenda. And if so, what the scope and the objective and the potential solutions for those issues could be. So that's a really important part of our process. And if you haven't had a chance to participate as part of the invitation to comment process, it's really great to be able to give your feedback at kind of the ground level before we even take on a project. So I really encourage you to be able to do so. And, we've spent a lot of time, I know already, I've talked a lot about our agenda consultation process from 2021 and really how that's impacted our technical agenda and our research agenda and how we've made progress on a lot of those topics is what you're going to hear about today. But certainly the logical question is, okay, if you've made a lot of progress on the projects that are currently on your agenda, what's next? And certainly I think what we're planning to do is to, if we go to the next slide, follow a very similar process to what we did in 2021, right? We're looking to go out with a new invitation to comment, and we've already started that process by talking to our advisory groups this fall about what our future priorities should be. So what we're doing is planning to summarize that feedback in a agenda consultation invitation to comment that we're going to be issuing this winter. And we're really interested in your feedback on that invitation to comment and encourage you to participate as part of that process. I think what we're hoping is that you can see that we listened the last time there was an agenda consultation process. We were able to take that feedback in from our stakeholders, and you can see the actions that we took on our technical and our research agenda. And I would similarly expect your feedback to influence our agenda going forward. So we certainly want to make sure that you have sufficient time to be able to provide that feedback, and hopefully we'll be in a position later next year to be able to kind of have a summary of that feedback and make decisions from a board perspective about what updates or changes need to be made to our technical and our research agendas. So I think it's a really exciting time here at the FASB to be able to see things moving forward from a progress perspective, but also to be looking around the corner of what's next. And that's a huge part of what we ask for our stakeholders is you guys are boots on the ground, understanding where there's challenges, where there's new and emerging areas that we may need to take on. And certainly that's what we're looking for from a feedback perspective with regards to the invitation to comment on the agenda consultation that'll be out this winter. Now, if we move to the next slide, I always think this slide is really helpful because when people say, well, you're looking for my feedback on the agenda consultation, is there anything I should think about when giving feedback? And I think it's a great question, right? And this slide really walks through kind of the 3 criteria that need to be met in order for the board to add a project to the technical agenda. Now, you can look at these and say, well, is it pervasive? Is there an identifiable scope? Do we have, potential solutions that can be addressed by the board? I think those things are all a matter of judgment in some cases, right? And that's really the decisions related to whether the project meets these criteria is a matter of individual board members' professional judgment, but your feedback and the research and analysis that's performed by the FASB staff is really what helps inform those decisions. So when you're thinking about providing feedback on the agenda consultation, I would just offer to kind of think about these potential, criteria and see whether or not you think those criteria would meet your threshold to be able to add those to the agenda. And feedback along that nature is really helpful for us because when the staff is going through and analyzing the different feedback that we hear, they're going to be marking it against these different criteria as well. So maybe as we kind of move off of where our technical agenda is and where we're going from an agenda consultation process, I think I'd be remiss as I'm lucky enough to be the chair of the Emerging Issues Task Force. So if we move to the next slide, I do want to just make you aware that we do have a project that the EITF did add to its agenda in October. And the board did take on this project in November. So this is a topic that came up from the EITF with regards to a debt modification question. The question really relates to when you have a repayment of an existing debt instrument with proceeds from a new debt that was issued to multiple creditors, whether or not that should be accounted for as an extinguishment or as a modification of the existing debt. And the objective of this project, and this is probably a more narrow issue beyond debt modification, which you might hear about as a broader question or area of feedback that we're hearing. This is a little bit more narrow with regards to what happens, right, when you issue new debt and you use that to pay off your old debt, and what's the accounting for that existing debt that's on your books. But I really think the EITF wanted to kind of take a look at this more narrow fact pattern and see if there was an opportunity to be able to simplify the analysis. Make it a little bit easier for people to see whether or not this just should be an extinguishment or it should be accounted for as a modification, because those have 2 very different answers from a financial reporting perspective. So the EITF did make a decision that would require the debtor to account for the 2 transactions separately as an extinguishment of the existing debt obligation and the issuance of a new debt obligation if the existing debt has been repaid in accordance with its original contractual terms or repurchased at its market terms, and the new debt was issued at market terms following the issuer's normal marketing process for new debt issuances. So I think the hope here is that these 2 criteria will be able to be objectively applied and will make it easier to determine whether or not you have an extinguishment of that existing debt. As I mentioned, the board did take a look at the consensus that was reached by the EITF and in November decided to add this project to the board's technical agenda, and the board did approve the staff being able to move forward with issuing a proposed exposure draft with regards to this issue and using the EITF recommended solution. So this is a document that I think you'll see going out in the first quarter of next year, and we'd really be interested in your feedback on that topic as well. And then maybe before I hand it over to the rest of our great team here today, did want to mention, if we move to the next slide, that in November we did issue our final ASU on our disaggregation of income statement expense project. And that project really is intended to improve the disclosures about a public company, a public business entity's expenses, and really address a lot of investor feedback that we've received over the years, that they're looking for that more detailed information about the types of expenses that are in commonly presented expense captions, such as cost of sales, cost of goods sold, and selling general and administrative expenses. Now, this is a really important project for the board, but if you're listening very carefully, you probably also noted that I referenced the fact that this guidance relates to a public business entity's expenses. And I do want to thank Michael and his fellow PCC members who were really instrumental in helping the board to consider the costs and the benefits of, should these disclosures be required for private companies? Members of the PCC generally supported excluding private companies from the scope of this guidance. And I think that feedback really did help to inform the board members and really help to inform their decision to limit this information or required to disclosures to only public business entities. Certainly, I think this is an area where certain board members expressed some potential future interest of, are these disclosures that may be helpful from a private company, user of the financial statement perspective. But I think the board really wanted to, see how the implementation from public business entities went, really understand how investors were using that information before they decided to, think about whether or not this should be required from a private company perspective. So again, I just really want to thank the PCC for all of their help with regards to our disaggregation of income statement expense project as well. So with that, I think it's time for a polling question, Jennifer.
Thank you, Hillary. Yeah, we can please launch polling question number 2 and ask, which of the following best describes the organization you work for? A lot of choices here. A, local CPA firm. B, regional or national CPA firm. C, private company. D, not-for-profit organization. E, user of a financial statement. For example, a lender, private equity, a surety, a grantor. And then F, other. Give folks some time to respond here. As I mentioned, you can ask questions during this webcast. We will do our best to answer them as we make our way through the various topics. And if we're unable to answer your question during the webcast, you can submit it, your accounting question, through our technical inquiry service located on the website. So while we're waiting for participants to respond, I have a trivia question, and that is, when was the PCC formed and who formed the PCC? And the answer is, the PCC was established in May of 2012 by the Financial Accounting Foundation Board of Trustees. Now, if you're not familiar with the Financial Accounting Foundation, or the FAF, that is an organization that supports and oversees both the FASB and the GASB. So we'll give folks a little bit more time here to respond. We understand how important getting your CPE credit is. So just a few more seconds here. Okay, I think we can go ahead and close the polling question and share the results. Fantastic. I love the diversity and the attendees that we have here today. It's great. Thank you. So at this time, I'm going to turn it over to Mike to talk about the PCC.
Thank you. Go on the next slide. So it's an honor to be here today to update you on the activities of the Private Company Council, or what we call the PCC. And as a member of the PCC, I believe our ultimate goal is to help the FASB improve, or FASB, improve financial reporting for private companies. But improving something always means something different to different people, and that's why we have members with different views representing the PCC. So if we move on to the next slide, I'd like to start by introducing you to the members of the PCC and who we are. So first off, the PCC members are nominated by the Financial Accounting Foundation, or the FAF, which is what Jennifer alluded to earlier, and that is the parent organization of the FASB and the PCC. Our PCC chair is Jerry Shaver, who took over in January of this year. And he took over from Candy Wright, who was our previous PCC chair. And as you can see on this slide, we have PCC members representing what we call three primary groups. So first, we start off with practitioners, and these are the CPAs in public accounting that primarily focus on serving private companies. They may not be CPAs, but I'm sure at one point they were. And then we've got preparers, and these members deal with the reality of applying US GAAP because they're responsible for preparing the financial statements at their companies. And I'm excited to welcome our newest preparer, Autumn Hindman from Maneater, who will start her term on January 1st of 2025. Last but certainly not least, our coveted user members. So these are the members who rely on US GAAP to help inform their capital allocation decisions. This group includes lenders, sureties, and what we call an academic, or I just see him as a professor from a school with a great basketball heritage for you longtime Jordan fans out there. And then going on to the next slide. As I mentioned earlier, our primary responsibility is to improve financial reporting for private companies. Recently, and likely in the near future, our focus has been striking a better balance between the costs and benefits of preparing US GAAP for private companies. So how do we go about this? I'm going to reverse the order a little and start with the right side. But first off, I want to tell everybody that we rely heavily on the FASB staff. They're wonderful and nothing would get done without them. Now, if you look on the right side, the box starts with outreach, which is understanding the views of private company stakeholders. So PCC members are leaders in their profession or their group, and the outreach starts informally through their networks and the experiences that they have in applying US GAAP or helping others apply US GAAP. We also have formal channels like the annual town hall that we host or hold at the AICPA Engage conference. We also hold liaison meetings with key stakeholders such as the AICPA Technical Issues Committee or TIC, RMA, IMA Small Business Shared Interest Group, and the ASB Audit Issues Task Force, to name a few. So based on that feedback, the PCC may take up projects on private company alternatives. So this is the middle box on this slide. I think the PCC is known best for this activity. This is where the PCC sets its own agenda, reaches decisions, and requires endorsement from the FASB to finalize a private company alternative under US GAAP. In making these decisions, we rely on the private company decision-making framework, which helps us decide whether and when there should be a difference in accounting between public and private companies. Think of the most, or perhaps the most popular alternative issued by the PCC and endorsed by the FASB, which is amortizing goodwill over a period of 10 years or less. However, we also serve as the primary advisory body to the FASB on private company reporting matters. So this is the most left side of the box, as the FASB considers standards beyond the scope of private companies. So think about revenue, where the FASB has scaled back significant amount of disclosures for private companies, or CECL, or credit losses, where we scoped out receivables or loans from entities under common control. And as Hillary mentioned earlier, with our feedback, the FASB has scoped private companies out of DICE or disaggregation of income statement expenses. Next, I will talk about PCC agenda priorities. And about a year ago, under the leadership of Jerry and efforts of the FASB staff, we discussed undertaking a more structured process to evaluate our agenda. And the purpose of this is to increase the PCC's efficiency and to best prioritize matters that have the biggest impact, I think, on private company stakeholders as it relates to financial reporting for private companies. So this is going to be a continuous process, and we'll revisit this periodically to make sure that we're addressing the right issues. But from April to June of 2024, PCC members ranked basically 16 issues in terms of importance. And this is based on feedback that we've had since, I think, before 2012 and just what we've dealt with throughout the years with the PCC. And ultimately, we came up with 4 issues to focus on. And that is credit losses, which we'll talk about in a future slide, presentation of conditional retainage and overbillings as contract assets and liabilities, and our favorite, leases, and also debt modifications and extinguishments, which I'll literally talk about in the next slide. So these are the issues that we ranked as the highest priority today, but that doesn't mean the other issues, or the remaining 16, I guess 12, if I'm doing my math correctly, won't come into play in the future. So we'll take a deeper dive on each of these issues, but I will start with debt modifications on the next slide. So if you look at amendments to debt, and Hillary did talk about this a little earlier, whenever you change your debt, you first have to consider whether you have trouble debt restructuring. And then you have to consider the type of debt that, if you don't have that, you also got to need to consider the type of debt that you're changing. So is it a revolver, which is based on kind of a borrowing capacity and whether you've increased or decreased your borrowing capacity? Or are you following the term loan model, which is based on the change in cash flows to determine whether you in substance have an extinguishment or do you actually have a modification in debt, which we usually say or draw a line between a significant cash flows or change in cash flows, which is an extinguishment, or something that's not as significant, and what we call a modification. So the focus of what the PCC is going to do is really just look at the term loan model, because we wanted to take this at one step at a time, and there's a lot of issues that we could address, but we wanted to make some movement. So I think that, you know, when we hear this model, it sounds easy to apply, but the devil's in the details, and it can be fairly complex. Especially when there's a syndicate of lenders where you have to perform this analysis on a lender by lender basis. And the impact of whether you apply this correctly or incorrectly will have a huge difference in what your P&L has. Like you could be booking a gain or loss on extinguishment, or you might not if you have a modification, which would change your future P&L on interest rate expense. So more to come on this, and we will be obviously observing the project and recent developments on the accounting for debt exchanges, as Hillary talked about earlier. Next slide talks about how you can stay up to date on all things PCC. So there are a bunch of links here that if you've got a copy of the slides, you can definitely click on. And as we mentioned earlier, the PCC engages with private company stakeholders in a variety of ways, and we're always seeking input on private company accounting matters. So please do not hesitate to provide us feedback and drop an email to Jennifer Weiss, our PCC coordinator, and you can see her email on this slide. And with that, Jennifer, I think you're going to take us to the next polling question.
I am. Thank you, Mike. So please launch polling question number 3. It asks, are you familiar with the PCC agenda priority process and the projects that have emerged from that process in 2024? A, yes. B, no. C, not sure. And while we're waiting, Mike, maybe you don't mind if I ask you a question. What do you like best about being a PCC member?
Don't mind. I love working and thinking about technical accounting. I mean, I used to work at the FASB and I got to do that as my job. But now as I'm applying it, you know, I find less time to think about this and working with staff like you and other PCC members. So.
Great. Thank you for that. We'll give folks just a couple more seconds here to respond to the polling question. We did have one question come in about where can someone find invitation to comments and exposure drafts that are open for comment? So you heard Hillary talk about the documents that we have open for comment currently. So if you go to our website at fasb.org, click on projects, and then a drop-down box will appear and you will see documents open for comment. Click on that and you will see the various documents, and then you can download them from there. Okay, with that, I think we can close out the polling question and share the results. Okay, looks like it's somewhat evenly split between yes and no, and a few with not sure. Okay, so we can move on from here. And Sue, I'm going to turn it over to you to talk about post-implementation.
Terrific. Thanks, Jennifer. And welcome, everybody. It's so good to see such a large crowd today, right before the holiday season. I guess everybody's interested in what's going on and looking forward to some CPE. But first, I wanted to spend a little bit of time on our post-implementation review process and just kind of give you a sense of the status of those PIRs, as we call them informally, and talk a little bit about the report we just issued. So next slide, please. So this slide recaps our PIR process, and maybe just to level set a little bit. We've talked about PIR a number of times on these webinars over the years, but for those that may be not as familiar with it, The way I like to think about PIR informally is really just an extension of the standard setting process. We often say, once we issue the standard, it doesn't mean our work is done. It means that we are now available to support implementation, understand where clarifications may be needed, understand whether the process that we undertook in developing the standard, sort of the costs and the benefits met our expectations. And so when I think about PIR, it's sort of the fundamental questions that are addressed as part of PIR is to understand, is the standard accomplishing its stated purpose? And maybe, said differently, did the improvement address the problem the board was intending to solve by its issuance? Another question would be, are there improvements that we can make to the standard setting process itself? Were there costs to implement the standard what we expected when we set the standard? Were the ongoing costs what we expected? Did the standard achieve the expected benefits? And so as we think about the PIR, we think about it in terms of stages. And so I call it the life cycle of PIR. Stage 1 is the post-issuance activities. So that's right when we issue the standard and before it's effective, we're monitoring implementation, and we will act, if you will, if we need to provide clarity through implementation guidance or education. Stage 2 is the post-effective date evaluation of costs and benefits. So understanding the actual costs that were borne by preparers and understanding the benefits that were derived from either from a preparer perspective or perhaps from information provided to investors, or even to improve operability of any particular area in terms of auditing it. So we look at that as well, and we do outreach with all of our stakeholders on that. And then stage 3 is really just a summary of our research and reporting to our oversight committee of the Board of Trustees. So as part of this process, we have regular touch points with the board and public meetings and throughout the project. And right now we really have 2 outstanding PIRs, one associated with leasing and one associated with our current expected credit loss standard. The report for revenue PIR was recently issued, and I'll talk about that next. So next slide, please. So in this section, we're really just going to talk about the findings from the FASB's PIR report on revenue. Next slide, please. The final report was issued on November the 25th. And you remember, and I was here on staff, but the revenue standard was issued back in 2014. And it was a standard that was developed and deliberated jointly with the IASB. So in and of itself, there's some complexity associated with how we actually developed the standard and the process that we undertook in terms of trying to work together with not only our 7 board members, but the other board members from the IASB to actually come to conclusions on those particular issues. And then at the time, and I sort of remember it vividly, trying to harmonize the words. And so we learned some things along the way, which I'll talk about in a moment. But the revenue PIR started with the issuance of the ASU, as I mentioned previously, as part of describing what PIRs are. And stage 1 provided information that allowed the FASB to support preparers with their implementation activities. So you may recall that we had a transition resource group associated with the revenue recognition standard. It was established to support practice in adopting Topic 606. It was made up of a number of our stakeholders and auditors, practitioners, preparers, and investors, as well as public companies, private companies, and not-for-profits. And this slide highlights the activities and interactions that went into the PIR process. So by the numbers, we had about 2,200 interactions with stakeholders in the PIR process. We issued 251 documents post-issuance, which included things like our transition resource group papers, which were documents that discussed very specific issues associated with points that perhaps needed a bit more clarity. Also, where we actually did make some improvements to the standard post-issuance, EDs, final ASUs, roundtable materials, among other things. And we have a compendium on our website where you can actually go and it's listed by topic where you can get more information on some of these more topics that we needed to provide more education on. So, and in addition, the staff actually responded to more than 500 technical inquiries. So you can see the chart on the right highlights what we found from those interactions with stakeholders to be the 10 most challenging areas identified in applying the topic 606, our new revenue recognition standard. And disclosures were by far the area that stakeholders found the most challenging. And what's interesting about this is, we certainly heard through our PIR process that in some instances, companies didn't really have a material effect on the amounts that were recognized in the financial statements, but almost all companies had disclosures changes and disclosure improvements and additional transparency and information that they needed to provide in their financial statements. So in terms of a sort of pervasive impact, if you will, revenue on the revenue recognition standard, disclosures was something that was pervasively applied by all companies. So followed by the other challenging areas, licensing certainly, where we did issue several improvements post-issuance date, I guess, to make some clarifications in that area, as well as a challenging area on the constraint as it relates to variable consideration. And when we think about those challenges generally resulted from areas where there was significant judgment, or perhaps where things were fundamentally changed, or where even there were emerging business models that had evolving or complex transactions, like principal agent, for example. Next slide, please. So this slide highlights the findings, if you will, as it relates to benefits and costs. So maybe I'll just highlight a few of them. The slide's a little hard to see. So investors appreciated the more useful and transparent information. They thought that the results were more comparable and consistent in terms of information across industries. And preparers highlighted the benefit of improving their understanding of their contracts. It was interesting to understand where oftentimes there was a little bit of a disconnect between, say, the accountants and the operations folks. And once that they needed to have a thorough understanding of the contracts, they could actually make improvements to how maybe they did their process. So it was also a catalyst for improving their internal processes. And also what we highlighted as a benefit was convergence with IFRS. Particularly global companies found that very helpful. On the flip side, as it relates to costs, while the nature of the costs seemed consistent with the board's expectations when they were setting the standard, particularly in industries where we had industry-specific guidance prior to Topic 606, when that guidance was removed, preparers highlighted to us that costs were significant. That wasn't necessarily unexpected, but it certainly was a cost to the system. Stakeholders also noted that significant costs occurred in where things were perhaps not materially different under 606, but that it was just different than what it was under 605. And then they also spent time, as I mentioned previously, on disclosures, processes, improvements, comprehensively reviewing existing contracts, and improving the control environment. And then stakeholders also noted that certain costs persisted beyond implementation, but that in some instances, those costs may have occurred under either standard because it related to, say, for example, business growth or some innovation that they were undertaking. So next slide, please. So as it relates to the three questions I mentioned earlier, the overall objective of the PIR, particularly, the conclusion was that Topic 606 accomplished its stated purpose. In other words, we had disparate guidance originally. We now have convergence with IFRS. We are providing greater transparency and consistency among transactions with similar economics. And the benefits and costs are consistent with the board's considerations and expectations of stakeholders. We received good feedback from this process to help improve the standard setting process overall. For example, the use of transition resource groups. That really was put in place to help the preparer have a voice in the system, particularly where things may not be as clear as what we thought they were. And also, the efficiency of the standard setting process was another area where we had feedback on and how we could improve that on a go-forward basis. However, with all of this said, the report acknowledges the challenges of the time and complexity associated with developing a converged standard. So for example, we learned that words matter. And while the board at the time thought perhaps certain aspects of the standard had little to no change, because of changing words, for example, to harmonize the standard globally. When things change, when words change, people change their application of the guidance. And so what we learned is we need to focus on perhaps harmonizing outcomes as opposed to understanding, when we're developing a converged standard, instead of actually focusing on individual words that may mean different things in different countries, say, for example. Leases certainly benefited in some way from some of the revenue, what we learned in the revenue process. And I'll acknowledge that was not an entirely converged standard. But I encourage you to read the report. It details out the process, the feedback, and the actions as a result of the process, both in terms of clarifications to help implementation of the revenue standard and process changes that helped with future standards. And I will say, just because the PIR report was finalized, to the extent that issues arise, please reach out to us. We are here to help, either through a technical inquiry or in addressing application issues as they may arise. So now I think, Mike, do you want to speak to PIR directly as it relates to some of the activities that the PCC has taken on?
Sure. Yeah, and one of those, I think, is what I alluded to earlier, one of the 4 projects that the PCC decided to take up, and this is the presentation of contract assets and contract liabilities for construction contractors. So just brief background, construction companies are often subject to contracts that contain these retention provisions, and they allow a customer to basically hold a portion of their consideration. And this essentially serves as leverage to ensure that the project is completed to the customer spec at the end of the project. And depending on how far along a contract there is, this could result in a contract asset because revenue has been earned and the company can't legally bill or invoice the customer for these retention amounts. So this is a step 5 issue on how far along are you in terms of progress and were you entitled to these amounts? And if you can't bill it, it's a contract asset. There's also advanced billings, which allow a construction company to bill ahead of progress, which results in contract liabilities. It's a liability because you've gotten money, but you haven't actually performed your obligation. And if this occurs in the same contract, GAAP requires these contract assets and liabilities to be netted because the revenue recognition standard is at a contract level. So we've heard loud and clear in the PIR process and feedback among, I would say, at least one PCC member, that users that focus on construction companies don't like the fact that retainage and these advanced billings are required to be netted. The purpose of this project or proposal is to provide construction companies the option to gross these amounts up to provide a little more detail on what those amounts are. Again, the PCC added this project to its agenda in September, made decisions. The FASB endorsed it and directed the staff to begin drafting the proposed ASU, which is currently in process. So we'll have to stay tuned on further developments in the future for this project. So with that, I think, Jennifer, you'll take us through the next polling question.
I will. Thanks, Mike. Please launch polling question number 4. Ask, have you had an opportunity to read the FASB's report on post-implementation review revenue from contracts with customers? A, yes. B, no. C, not sure. And while we're waiting for folks to respond, we do have a few questions that have come in. Do any of the speakers wish to address those questions at this time?
Sure, Jennifer, maybe I could jump in. I know there was a question that we received with regards to whether the board has finally completed the conceptual framework or not. And I can very happily say that, yes, we have completed the conceptual framework. We were able to issue the measurement chapter of the conceptual framework earlier this year. And that means that we have completed a project that has been on the board's agenda for an extensive period of time. And I think importantly, really having that full, complete conceptual framework, which is a tool for the board to use from a decision-making perspective, is just a really important part of our process. So again, I think this is a really great achievement from the board and from the staff's perspective, and it'll be something that will pay dividends for many years to come.
Thanks, Hillary. Are there other questions that speakers would like to address at this time?
I can address, Jennifer, the question around where can I find the revenue recognition post-implementation review report. And if you go to our website and you go under projects and you go under recently completed projects, it's the second item listed there. That's the easiest way that I found to connect to it fairly quickly.
Great, thank you. Give folks just a few more seconds here to respond to the polling question. I'm going to make sure you get your CPE credit. Okay, with that, let's go ahead and close out that polling question and share the results. So it looks like a lot of you have not had the opportunity to read that report. Hopefully, now that Sue has provided an understanding of where you can find that, you will have the opportunity to read that in the future. Okay, with that, Sue, I'm going to turn it back to you to talk about leases post-implementation review.
Terrific. Leases. So I think we want to just spend a little bit of time talking about where we are with respect to the leases PIR. This is one that's currently in process, currently in stage 2. And if you could move to the next slide, please. The most significant activities that are currently underway are as it relates to non-public entities. And so the outreach that is being conducted currently is related to preparers and practitioners, and specifically on costs and benefits. And the staff is planning to initiate a preparer survey to assist them with this aspect of the process. You can kind of see, again, this is sort of the same similar timeline to what I showed earlier with respect to just generally what our stages are for the PIR process. And so I won't talk a little bit about the PCC's efforts. I'll let Mike do that in a little bit. Next slide, please. And so this is really just a snapshot of some of our recent discussions with advisory committees and with the Technical Issues Committee of the AICPA. For example, when we talked to them about how leases implementation had been and costs in the system and benefits, et cetera, NAC talked to us, the Not-for-Profit Advisory Committee, about how software has helped them to reduce cost and complexity of applying the standard. I think the PCC, most of the discussions have been around their establishment of a leasing working group to assist them with project research. Mike's going to talk about that in a minute. And then we also talked to the TIC, which highlighted an area of where they thought there was ongoing implementation concern around lease modifications. And so maybe, Mike, do you want to just more specifically talk about the PCC's research project?
Yeah, sure. So I'm not surprised here. I think I've been attending the PCC town halls, and I haven't actually checked, but I'm willing to bet quite a bit of money that we've probably at least raised it every single meeting for the past decade. And leasing has been implemented for a while now. So while 842 provides some relief for private companies in certain areas, PCC members and stakeholders have indicated that we could probably still provide some additional simplifications. What that is, we're not certainly clear yet, but that's why we created a PCC leasing work group several months ago. And the purpose of this work group is to identify specific issues within 842, conduct further research, and determine whether identifiable solutions exist. This working group will work in parallel with and be informed by the FASB's leases PIR project. And recently, the FASB staff and leases work group have finalized their outreach plan, is in the process of conducting this outreach. So if you work for a private company, please don't hesitate to reach out if you know how to simplify leases. And that's all I really have to say on this, because it's still in the beginning stages. So with that, Jennifer, I think you'll take us to our next polling question.
Yeah, thanks, Mike. Please launch polling question number 5. It asks, are any of the following areas challenging when applying topic 842 leases? If more than one, please choose the most challenging area. A, embedded leases. B, lease modifications. C, lessee allocation of fixed and variable payments. D, other area not listed above. And E, no challenges exist. There are a number of questions that we've received, one of which is, what does TIC stand for? TIC is Technical Issues Committee. That is an AICPA committee that is comprised of practitioners, with a focus on private companies, and they are one of the groups that the PCC meets with on a regular basis. Are there other questions that have come in that speakers would like to address at this time?
Jennifer, I'd be happy to pick up the one about, does the FASB undertake a cost benefit analysis for standard implementation prior to finalizing a new ASU? And the answer to that is that, yes, we do. Actually, when the staff prepare board memorandums for us on all of the individual decisions, each individual decision has an analysis of costs associated with it and benefits. And then before a standard is finalized as a whole, there's a discussion about costs and benefit when all of those decisions are taken as a whole, to try and understand, as we evaluate, does the benefit of a standard, is the cost worth the benefit? So it's not always as clear, but we do provide quite a lot of information, and our basis is for conclusions on the costs that we've assessed and the benefits that we've assessed.
Thanks, Sue. I want to give folks ample time to respond to the polling question. Are there other questions that have been submitted that speakers would like to address? No one's jumping in here right now. It's okay. So I did have one question that I would like to address, and that is, are PCC members volunteers, or are they considered employees of the FASB or the FAF? The answer is they are volunteers. They do go through an appointments process by the FAF trustees, but they are not employees of the FAF or the FASB. Okay, with that, let's go ahead and close out the polling question and share the results. Okay, not a surprise for what we've heard through stakeholder outreach. Embedded leases and lease modifications are certainly challenging areas. So if you all have suggestions on how those areas of the guidance might be simplified for private companies, please reach out to me. We would love to talk to you. So with that, Sue, I'm going to turn it back to you and talk about credit losses.
Thanks, Jennifer. So next we'll spend a moment discussing our current expected credit loss model and our standard and its current implementation. Next slide, please. So CECL, as we fondly refer to it, was effective for calendar year and non-public entities in 2023. And for off-cycle year ends, it's effective in fiscal year 2024. And this slide really highlights what is currently in scope. And for example, trade receivables, loans and debt instruments, financial guarantee contracts and loan commitments, and certain lease receivable and financing receivables. What's not in scope is contribution or pledge receivables when following the contribution model, and loans and debt measured at fair value through net income. I will say that Mike will highlight in a moment the active project that we have on our agenda related to trade receivables. And Lucas will discuss later one aspect of, as it relates to not-for-profits affected by codification improvements. Next slide, please. So as it relates to PIR on CECL, we are currently in stage 2. And really all I wanted to do here was just to highlight this one particular active project that we have related to some concerns highlighted by investors that came in as part of the PIR process. Mostly this would affect financial institutions. So I'm not really sure how many of those that we have in the audience today. So I just want to briefly highlight it so you're aware that the CECL standard, so that you're aware that we have this project ongoing. And really what it relates to is the CECL standard's current distinction between purchase credit deteriorated loans and non-purchase credit deteriorated loans, and the resultant unintuitive effects on the financial statements and the complexity as a result of making that distinction. Some current efforts of the board are underway to try and address the issue. The work is ongoing, but since it won't affect most in our audience today, I'm not going to spend too much time or detail on it. But what I would like to make sure that we have ample time to discuss is what's going on with the CECL and trade receivables project. Mike, are you going to take us through this one?
Sorry, definitely. Still trying to learn how to unmute things here, right? So of the 4 projects, I would say that, the PCC added to its agenda, this is clearly the furthest along. The scope of this proposal includes current receivables or contract assets that are generated under Topic 606. So that means receivables or contract assets resulting from the sale of goods or services that are part of the company's ordinary activities, what we do to make money. To understand what this proposal does, I'd like to start with what we probably have to do today under CECL. So within the scope, again, of current accounts receivable or contract assets, what we have to do, generally speaking, right, is to estimate what we don't think we'll be able to collect. And generally, a crystal ball is very helpful when you're making this estimate. To do this, we generally start with a bucket of we generally start by bucketing receivables into similar or homogeneous groups. Then we look at history to estimate CECL. So we'll look at historical losses for similar types of receivables based on historical experience. And for most of us, it's based on AR aging. So what's current and what we haven't collected based on history, or maybe what's 1 to 30 days. Some of us might stratify that a little differently, but by different overdue buckets, what is the impact on collection? And we'll also consider basically adjustments for unique circumstances, like those customers that might be going through bankruptcy. Clearly, we would establish a much higher reserve, or perhaps fully reserve for those receivables, even if they're current today. And history would suggest that we could collect most of that. So we would kind of strip that out to make sure our estimate's a little more, it makes a little more sense, right? And I think for most of us, especially for larger receivable portfolios, are okay up to this point. But this is where I think things changed under CECL, especially when we first applied it. And this is relating to forecasting economic conditions, right? So what we have to look at is our historical loss rates, and then come up with a current reasonable and supportable forecasted economic conditions and how that will basically impact our loss rates. And I think that was very tough for private companies, and coming up with this forecast involves significant effort and documentation. Often analyzing macroeconomic data, which may not really affect or materially affect the allowance for our receivables or contract assets within the scope of this proposal. So in other words, it was a lot of effort, and there was really not that much change. And I think we saw that in public companies that are not financial institutions, along with private companies that applied CECL. So what does it look like in the future if this proposal goes final? I think it was very eloquent in how the standard came up, or what the FASB staff or the FASB proposed on this. And that is essentially removing the toughest part of applying CECL to these types of assets, and that is the forecast of future economic conditions. And we do this by allowing you to assume whatever the economic conditions are today will persist throughout in the future when you're making this estimate. And there's also some alternatives to make this a little easier, which I can go through in a little more detail as I go through in future slides, because I think a picture is worth 1,000 words. And in this proposal, they also provided examples on how to apply this practical expedient that we are suggesting if this goes final. So I personally believe this proposal will significantly simplify the application of CECL for most non-public organizations without materially changing the quality of financial reporting. So let's jump to the next slide. As you can see here, the election of the practical expedient in example 1 is all you would essentially have to do if there's no unique receivables that you'd like to pluck out. So what you see here is you've got your AR balance that's roughly 6 million stratified in the different buckets. You apply your historical loss rate, and then extend that over and calculate it, and you're done if you don't got anything that needs further adjustment. And I think this is part of what we did historically. In example 2, this is basically the same thing, but perhaps you might have a receivable that has a unique circumstance. So in the proposal, you'll see an example where a customer S is embedded in the 1 to 30 day bucket, where there's $2,000 of balance, which is fairly current. And they fully reserve for this because the customer S has recently filed for bankruptcy. But after you pluck that out, we apply the same percentages as you see up above, and then extend that and prepare or estimate CECL without, again, considering how economic conditions will change, because we can assume whatever's happening now will persist. And then example 3 on the next slide is one where it talks about a practical expedient that I kind of alluded to. So this allows for some companies, you don't have to do this, right? If you want to consider collection activity that has occurred after the balance sheet date, but before financial statements are made available for issuance. So what you see here is the same AR balance, but maybe your financial statements are going to be issued in this example on March 1st. Of the following year, and you already know what you've collected. So what we can do there is assume that these are not going to be reserved for at all, meaning there's no CECL reserve for anything I've collected, and now you've got your remaining uncollected balance. And then from there, if you forecast basically 30 days later, right, if you haven't collected this, it's probably going to be in the 31 to 60 days past due, and you would apply your historical loss rates there. The next one over, which was originally 1 to 30 days past due, will now become 61 to 91 days past due. That's that 4,596. You would apply your historical loss rate, extend it, and that would be your new CECL reserve. So this is a practical expedient that could be very helpful in applying what we're talking about here, especially if you collect substantially most of your receivables by the time you issue your financial statements. So I think that this is a fantastic proposal, and I'm excited to see what feedback is on this. All right, Jennifer, I think that's you're up now for the next polling question.
I am. Polling question number 6. Please launch that. So this relates to the proposed amendments that Mike just talked about. Do you anticipate that the proposed amendments associated with the credit losses topic 606 receivables project will reduce the cost and complexity and applying the credit losses guidance to current accounts receivable and contract assets arising from transactions accounted for under topic 606, revenue from contracts with customers for private companies and not-for-profit entities, excluding those that are not-for-profit conduit bond obligors? A, yes, B, no, C, maybe, D, not applicable. Well, folks are responding. Are there any questions that speakers would like to address at this time? Okay, well, I can address one about the FASB's technical inquiry service. Someone's asking about how does it work? So if you go onto the FASB's website and you click under standards, there's a drop-down box and you can get to the technical inquiry service from there. There's a form that you have to fill out with your contact information, talk about the question that you have, citing any paragraphs from the codification that you are looking at, and then also state your preliminary conclusion. Once you hit the submit button, it will be routed internally here, and a FASB staff will be assigned to your question, and they will reach out to you and set up a meeting to talk about it. So, are there any other questions that people would like to address at this time?
I can address one of the questions that I just covered because it's probably fresh in people's head.
Sure.
The question is related to the intended goal of the project on contract assets and I think contract liabilities in the construction area. So today in US GAAP, if you've got retainage or what could be contract assets, and you've got advanced billings, which are contract liabilities, today you have to net those under US GAAP. The feedback that we heard from users that focus on construction companies is they don't want to require the netting of that. They want more information on retainage or what that amount is, and then advanced billings and what that is for a particular project. So the option is only focused on companies within the construction industry, and it will give them an option to gross up those balances rather than requiring the netting of it. So it's very focused in the construction industry. And I think there was another question related to not-for-profits. It would not impact you as originally discussed.
Thanks, Mike. So users want more transparency.
Yeah.
Okay, so with that, let's go ahead and close out the polling question and share the results. Okay, great. It's kind of dispersed between yes and maybe. So with that, we're going to move out of post-implementation, and Jeff M. will talk about the Not-for-Profit Advisory Committee.
Thanks, Jen. Before I talk about what was discussed at the September 2024 meeting, I just wanted to take a minute and remind folks about what the NAC is and what it does. The NAC, which is the Not-for-Profit Advisory Committee of the FASB, is the primary advisory group to the board and staff on behalf of the not-for-profit sector. It was established in 2009, began meeting in 2010. Its charter allows for 15 to 20 members. There currently are 18 members, consisting of a mix of preparers, practitioners, and users of financial statements, similar to the mix of the PCC. In this case, the users are lenders, rating agents, folks from rating agencies, grantors, and so on. NAC members are appointed by the FASB chair, Rich Jones, and I have the pleasure of serving as the chair of the committee. Let's move on to the next slide. So at the September 2024 NAC meeting, probably the most noteworthy topic discussed was the upcoming agenda consultation. This was an outreach discussion, similar to what the board and the staff have had with other advisory groups and other key stakeholder groups. And perhaps the most noteworthy thing that we heard from NAC members was that, especially after all the major changes in recent years to GAAP affecting not-for-profits, both general changes a la RevRec and leases, as well as not-for-profit specific changes, such as those from ASU's 2016-14 on financial statements and ASU 2018-08 on grants and contributions, there aren't any significant further improvements needed to GAAP at this time. Thus, NAC members also indicated to us that they'd be fine if the current state of standard setting, where we have no not-for-profit specific projects and limited impact from other projects, were to continue. NAC members did, however, mention some areas for potential improvement. NAC members noted that none of them are urgent, but that the FASB could explore them on behalf of the sector in the coming years. And that's what's on the rest of the slide, highlights of what we've heard about particular areas. First, one of our lender users suggested that improvement to debt disclosure requirements could be explored to make those disclosures more informative, while a few of the NAC members indicated that the qualitative liquidity disclosures that were added to GAAP by ASU 2016-14 a few years ago had in many cases become overly boilerplate and perhaps could be re-examined to make them better. Second, some members indicated that the board could work on an area that was examined but not completed in the 2016-14 project, that is operating measures, along with perhaps some other financial key performance indicators affecting not-for-profit organizations. Third, another area that was mentioned was the not-for-profit consolidation guidance. While NAC members indicated that it wasn't leading to lots of non-intuitive consolidation results, the guidance was difficult at times to navigate through and could therefore be an area ripe for some streamlining and perhaps some simplification. Fourth, while ASU 2016-14 eliminated the requirement for not-for-profits also to present the indirect method for operating cash flows if they present the direct method, some of our user members thought that there could be opportunities for improving the indirect method when that was used. And then finally, a couple of members talked about the difficult judgments entailed in accounting for software agreements that have both a license component and a service component, and asked whether the FASB could explore an expedient in that area. So those were some of the areas highlighted as potential agenda areas by our NAC during the discussion on the September 2024 meeting. Let's move on to the next slide. And at the meeting, NAC also discussed some standing agenda topics, PIR activities, select FASB current projects, and their usual discussion on recent not-for-profit trends, concerns, and observations. With regard to PIR, similar to what we heard from the PCC and some of our other private company stakeholders, as Mike just talked about, NAC members indicated that the CECL model is more complex than the previous incurred loss model, but noted that there aren't material differences typically in the amount of recognized credit losses, especially for short-term trade receivables such as student AR and patient AR. NAC members also requested a practical expedient for collections on such receivables after the balance sheet date but before the date the financial statements are made available for issuance. Now, given this feedback, the board decided when endorsing the PCC's proposals also to scope in not-for-profits other than those with public debt. That is, not-for-profits other than those that have issued or are conduit bond obligors for securities that are traded, listed, or quoted on an exchange or an over-the-counter market. Thus, the proposal that Mike just reviewed should also be of interest to those of you who work in or with the not-for-profit sector. The NAC also discussed the current projects on software costs, environmental credit programs, and derivative scope refinements, all of which have had, now have, or soon will have exposure drafts out for public comment. Finally, in their trends, concerns, and observations discussion, NAC members talked a bit about cybersecurity risks and artificial intelligence, but they didn't identify any financial reporting issues needing the board's attention. So that's, again, some highlights of what was discussed at the most recent NAC meeting. Let me throw it back to Jen for our next polling question.
Great, thanks, Jeff. Please launch polling question number 7. It asks, have any of the topics discussed at the September 2024 NAC meeting affected your organization? A, yes, most of them. B, yes, some of them. C, no. And D, not sure or not applicable. We had a question about slide 43 and whether that was an internal analysis or an example footnote disclosure. Slide 43 was one of the slides that Mike went through in regards to the credit losses topic 606 receivable project. And that slide is intended to be an internal analysis. So that is an example of how one might apply the proposed practical expedient accompanied by the accounting policy election. So that is not a footnote disclosure. Are there other questions that speakers would like to address at this time?
Jennifer, I'm happy to take a couple. So one of the questions was, has the PCC considered differences for private companies with respect to revenue recognition? So I wanted to talk just for a second about the actual development of the standard, because the PCC was involved in the development of the revenue recognition standard. And while there aren't recognition and measurement differences, there certainly are disclosure differences based on the feedback that we got from the PCC as the standard was being developed. And I think, so that's important, as well as certainly there was effective date differences from public companies that the PCC provided feedback on. So I think on a go-forward basis, I think there's a couple of issues that perhaps the PCC will be considering on a go-forward basis, but it's very, very preliminary at this point in terms of just research or suggestions that have come up in town hall meetings.
Thanks, Sue. Any other questions that folks would like to answer at this time? Okay, I think we can go ahead and close out the polling question and share those results.
I could answer one more, Jennifer,
Okay.
if you want.
Sure.
So it has to do with what the intended goal of the revisions or the analysis for contracts assets in the construction area. So that's that conditional retainage project that we have underway. I think the idea there is investors or users of construction company financial statements had more information under topic 605 in terms of the balance of contractual retainage. And so in some instances, it's included in contract assets. In other instances, it's included in receivables. And so the idea there is to really, it's a transparency project to try and provide them the information they need, and that the standard, there's some question as to clarity as to whether or if they can provide it under 606.
Thank you. So with that, we're going to move into technical agenda projects, and Jeff M. is going to talk about accounting for government grants.
Thank you. We can move on to the next slide. So the board recently issued a proposed ASU on the accounting for government grants by business entities. The comment deadline is March 31st, 2025, and the guidance would apply to all business entities receiving government grants. As many of you know, not-for-profits already have on-point guidance on this area in GAAP in subtopic 958-605, which we last improved a few years ago with ASU 2018-08. In contrast, business entities do not have on-point guidance in GAAP. And in the absence of that, business entities analogize to IAS 20, which is the international standard in IFRS, or less commonly to the not-for-profit guidance in 958-605. In the 2021 agenda consultation, most respondents who answered questions in this area suggested that we leverage the guidance in IAS 20, but make targeted improvements where necessary. And indeed, we did a follow-up invitation to comment specifically on this project where a majority of respondents also suggested IAS 20 as a starting point. And anyway, that's what this current proposal does. It leverages IAS 20, but makes improvements where necessary. Now, one of the improvements is to limit the scope of the required guidance to transfers of monetary and tangible non-monetary assets to businesses from governments, including both outright transfers and forgivable loans. Sticking to monetary and tangible non-monetary assets avoids the typically more challenging issues associated with intangibles and services. Businesses, though, wouldn't be precluded from analogizing to the guidance and accounting for those assets if they wish to do so. Let's move on to the next slide. And this slide has the nuts and bolts of the proposal. The box on the lower right-hand side has a little more on the transactions, on which transactions are scoped out of the proposal. Like IAS 20, transactions involving income taxes are scoped out. The proposal also scopes out below market interest rate loans and government guarantees. And on the other hand, for clarity, the proposal scopes out exchange transactions rather than using the transactions in the ordinary course of business language that's contained in IAS 20. So those are the key scope exclusions. Grants would be recognized using a similar probability-driven threshold as IAS 20, but as you'll see from the upper right-hand box, for clarity, the proposal uses the term probable in assessing the likelihood of compliance with conditions and of the receipt of the grant, rather than using the reasonable assurance language of IAS 20. The box on the left-hand side, the large box, or a couple of boxes, shows that the proposal keeps much of the flexibility of IAS 20 to help preparers report on the wide variety of grants that businesses can receive from governments. Like IAS 20, the proposal distinguishes a grant that is related to an asset, that is a grant for the construction or acquisition of an asset, such as an element of property, plant, and equipment, or something like that. Anyway, distinguishes that from all other grants, which are called grants related to income. Grants related to assets would be accounted for under one of two approaches. With the first of those two approaches, the cost accumulation approach, the grant would be recognized in determining the carrying value of the asset with no separate recognition of the grant proceeds and earnings. Grants of tangible non-monetary assets would be measured at cost, if any, to the entity. Meanwhile, in the second approach, the deferred income approach, the grant would be recognized on the balance sheet as deferred income and subsequently in earnings on a systematic and rational basis over the periods in which the entity recognizes as expenses the related costs, typically via depreciation. Grants of tangible non-monetary assets would be, under this model, under this approach, would be initially measured at fair value. Income statement presentation would either be on a separate line item, such as other income, or as a reduction to the related expense category. With grants related to income, the grant proceeds would also be recognized in earnings on a systematic and rational basis over the periods in which the entity recognizes as expenses the related costs for which the grant is intended to compensate. And in this case, there could be a variety of costs, for example, employee salaries or consultants or travel and so on. The income statement recognition, similar to in the similar to the deferred income approach for the grants related to assets, would be either separately on a line item such as other income, or as a reduction to the related expense. And again, there could be all sorts of different expenses here. Now, there's some good examples on these models, on these approaches in the exposure draft, including one example of a grant with multiple conditions. a grant that is in part for the construction of a new headquarters facility, and also in part for hiring of employees to work in that facility. Let's move on to the next slide. Disclosures for government assistance that came into GAAP a few years ago with ASU 2021-10 would be incorporated into the proposed guidance for government grants with two noteworthy amendments. First, for a grant related to an asset that is accounted for using the cost accumulation approach, the disclosure of the line items and amounts affected by the grant would only be in the year the grant is first recognized on the balance sheet, not in subsequent years. And the second amendment would be the fair value of a tangible non-monetary asset received would also be disclosed at that time, either under a cost accumulation approach or under a deferred income approach. Now with that, I'm going to turn it over to Jeff DeBello, who will talk about our software project.
All right, thank you very much, Jeff. You can turn it to the next slide. So this is a project that is now in exposure draft. The exposure draft is out for comment. It was issued at the end of October, and comments are due by January 27th of 2025, as we're coming to 2025 already. If this is something that's of interest to you, we encourage you to submit a comment letter on this. So the issue dates, the project stems from the 2021 invitation to comment, in which the board heard that the current guidance on software, on the capitalization of software costs for internal use software lacks relevance and is outdated. It was developed 20, 30 years ago plus, and is not really representative in all cases of how software is developed today. So, and the main comments were that the main feedback was that the guidance is really based on a prescriptive approach, a staged approach, what is referred to sometimes as a waterfall approach, and the stages of when you would consider capitalization of costs are based on stages. However, software is also developed perhaps more frequently using more of an iterative approach. For example, maybe like one functionality of your software program is developed from start to finish before you begin developing any other functionality. So that doesn't match up very well with that sort of prescriptive staged approach. So the board was looking at trying to improve and modernize the guidance for software. So this really focuses on internal use software in subtopic 35040. And just as a reminder, that relates to costs to develop software for internal use, such as like an ERP system, or like in the not-for-profit space could be an app to receive donations, or a university to have course registration software, or software to attend online courses, or in healthcare for patient portal. So many examples of internal use software in the not-for-profit and private company space. The scope of 35040 relates to costs incurred by a customer to implement a cloud computing arrangement. So just as a quick note, this exposure draft does not touch upon, or does not have in its scope subtopic 98520, external use software that is developed to sell or license to external customers. So it's just for internal use software. And again, it's really to modernize the development of software costs. And also, just as an important note, this is talking about the capitalization threshold, or when to capitalize software costs. It does not deal with what costs to capitalize or when to begin amortization. So there's no proposed changes to that. So let's move on to the next slide. So this gives you some really colorful, gives you some idea, gives you this new capitalization threshold. So it's going to get rid of, in the top left-hand box, get rid of the staged approach, and it's going to replace those stages with a capitalization threshold. So entities would begin capitalizing the software costs when management is authorized and committed to funding the software project, and it is probable that the project will be completed and the software will be used to perform the function intended. So in developing that, in determining whether you've reached that threshold, there are going to be some additional criteria which are going to be added to the guidance in the middle box on the left-hand side to evaluate when you should begin capitalizing and consider whether you have significant development uncertainty. And if you do have significant development uncertainty, you may not be at the stage where you are at that threshold that I just mentioned, where you could begin capitalizing. And some of those considerations would be that the software being developed is novel or unique or has unproven functions, features, or technological innovations, or the entities has determined the significant performance requirements, that is what the software needs to do, including whether the entity has identified or continues to substantially revise the software's significant performance requirements. So if you're still in that if you're still in that significant development uncertainty, you may not be at that capitalization stage. This guidance will also incorporate the website-specific recognition guidance in subtopic 35050 and merge that into this internal use guidance. And then for disclosures, the existing disclosures relating to PP&E and the notes, risks and uncertainties, and various R&D disclosures will continue to apply. Additionally, there will be an additional requirement in the statement of cash flows to separately present cash paid for capitalized internal use software costs separately as a separate investing cash flow. So now I'm going to turn it back over to Jennifer for our next polling question.
Thank you, Jeff. Launch polling question number 8, please. It asks, will the proposed amendments to the internal use software guidance affect your organization or those you audit? A, yes, B, no, C, maybe, or not applicable. And while we're waiting for folks to respond, are there questions that speakers would like to address at this time?
Jen, there's one I can address having to do with with topic 832 and not-for-profit conduit bond obligors. The question is, would conduit bond obligors that are not-for-profits use this topic 842 accounting, the proposal that's out for public comment, for government grants? Want to confirm that they are scoped out. Indeed, they are scoped out. As I mentioned earlier, not-for-profits have on-point guidance in subtopic 958-605, which includes both gifts and grants, including grants from government entities. It was just business entities that are scoped out of 958-605 for government grants. And that's what this guidance is trying to plug a hole for, the proposed guidance. So yes, not-for-profits would not be within topic 832, including the proposals.
Thanks, Jeff. Are there other questions that folks would like to address at this time?
Jennifer, I can address one. There was a question on the timeline for PFA, which is the purchased financial assets. It's that CECL PIR one that I didn't spend a ton of time on. I don't have a great answer on what the time frame for finalization is. It is in redeliberations. We did meet on it last in October. The staff, as I understand it, is doing some research on understanding a potential scope exception for credit cards, consumer revolvers, and other things. But we haven't made those decisions just yet. So my sense is we'll probably be talking about it or continuing our redeliberations in 2025. And all I can say is just sort of watch this space.
Great. Thank you. So stay tuned.
And Jennifer, I can answer one question on software. It said, does this apply to software developed? Did I say that this does not apply to software developed for sale or relicensing to others? And yes, I did say that. You may remember, if you were following this project, that the original project did consider changes to external use software. However, based on user outreach, the board decided not to, that there weren't any significant issues, or that users really didn't want to see any additional capitalization or increased capitalization of software costs. The board decided not to pursue any changes to the external use software based on that user feedback.
Thank you, Jeff. This time we can go ahead and close out that polling question, please. Okay, thank you. And Jeff G., I'm going to turn it back to you.
Great, thank you. Now I'm going to talk about environmental credit program. So you could go ahead to the next slide. This is not an exposure. I know that it's just to cut to the chase. There will be an exposure draft that is expected to be issued before the end of this year, and I believe the comments will be due in April 15th, 2025. So stay tuned for this. So this is basically. Essentially, there is no gap for these types of credit programs. There are entities analogized to inventory guidance, I understand, or other guidance, but there really is a need based on the invitation to comment to have guidance for these types of environmental credit programs. It is going to create the proposal. This is again not yet a proposed ASU, but will be coming out very soon. Is going to create assets and liabilities on a gross basis that would be recorded separately. So you'd be looking at, and these are the proposed definitions. So what is an environmental credit? The definition kind of walks you through this, and it's really a transferable right represented to prevent, control, reduce, or remove emissions or pollution that is not an income tax credit. And there are many types of these types of credits that are out that exist, and you'll see those on the bottom left-hand side, the various types of programs that come in various different flavors. But again, they all have that same sort of characteristic that they are designed to prevent, reduce, control, or remove emissions or pollution. And so, then there are certain types of credits which are not in scope. And again, tax credits, renewable clean energy types of tax credits, investments in partnerships or other equity structures that generate these credits are also not in scope. ESG type reporting not in scope. And additionally, like if you make a payment, some international airlines will ask you to make a payment to offset your carbon footprint. Those are also not in scope. So again, there's these certain types of credits that are in scope. Some are granted, some are purchased or acquired or obtained by entities to offset their emissions. So an environmental credit obligation is the liability that would result. And that's an obligation that arises from existing or enacted laws represented to prevent, control, or reduce or remove emissions or pollution. So there has to be some sort of obligation that's offset to these assets. It's important to note that net zero or carbon neutral programs do not result in environmental credit obligations. So next slide, please. So as the asset recognition, again, the asset and liability recognition are going to be separate here. And so you would recognize an asset when it's probable the entity will sell a credit or use the credit to settle an environmental credit obligation. Otherwise, you will expense credits as incurred. So if, let's say, you're a nonprofit that acquires these credits to offset the carbon footprint of other entities, for example, then you would be expensing that as incurred because the entity itself does not have an environmental credit obligation. These credits would generally be measured at cost less impairments with exceptions. So certain credits that are probable of being used to settle an ECO are not subject to impairment, ECO being an environmental credit obligation. They would not be subject to impairment. There would also be an accounting policy election, a fair value option for a certain class of noncompliance credits to measure those credits at fair value with changes in fair value recognized in earnings. And that's recognizing that some of these credits actually are traded, and that's a growing market and developing market, and certain of these credits, the proposal is that they would be recorded at fair value through earnings. Next slide, please. The liabilities a little bit. So the liability recognition, again, is separate. So it would be, you would recognize a liability for the number of credits that would be due to a regulator as if the date to remit those credits is the balance sheet date. So it's an as if assumption there. And then the liability would be split essentially into two portions. The first portion is the funded liability. So the funded liability is the liability for which you already hold credits. So, and then the unfunded liability is the liability for which you would have to purchase or obtain those credits to satisfy this environmental credit obligation. So there's a simple example here to kind of walk you through that. Let's say you have 1,000 tons of emissions as of the balance sheet date, and you would have to remit 1,000 credits. You hold 800 credits for which you paid $8,000. in the past. You would have to obtain another 200 credits, and the fair value of those credits is $15. So you would have to spend another $3,000. So you would recognize a liability for the $8,000 plus the additional $3,000 that you would have to spend, and then that difference would go through earnings. So you would have to recognize an expense as well. You would have to update that liability each period as necessary. So, and again, this is gross presentation. You would have an asset of $8,000 in this example and a liability of $11,000. On to the next slide, please. We would have there are some next steps. Again, I said the proposed ASU is due out by the end of this year. And there should be hopefully ample time to provide comments if this is of interest to you by April 15th next year. There are also some additional proposed disclosures, both qualitative and quantitative. There would be information about the regulatory programs that give rise to these environmental credit obligations, information about an entity's environmental credits, including how an entity obtains them, and then various quantitative disclosures, significant holdings of those credits, a description of those, cash paid for environmental credits acquired, information about sales of those credits if you've sold them, information about the expense recognized and impairment, and then disclosures of a fair value if you are recording some of those credits at fair value. So I think we go to another polling question, if I'm not mistaken.
You are not mistaken. We are now on polling question number 9. Will the proposed amendments on the Accounting for Environmental Credit Programs project affect private companies or not-for-profit entities? Your choices are A, most private companies and not-for-profit entities will be affected. B, some private companies and not-for-profits will be affected. C, very few, if any, private companies and not-for-profits will be affected. And D, not sure. So as participants are responding, are there questions that speakers would like to address at this time?
Yeah, I could address one of them. I think this came up twice. So this is how should contract assets and contract liability be presented on the balance sheet? Should they be netted together upon presentation? So I do appreciate there's levels to this. So I'll try to be as clear as possible, hopefully. And yes, under current GAAP, without the proposal in play, you have to net contract assets and liabilities at the contract level. So if you've got one contract where you maybe build ahead of schedule, so you got money, but you haven't done any of the work, that would put you in a contract liability position. But then let's say you did a lot more work and even further along than what you've collected, that would have to now flip to a contract asset. That's what current GAAP requires. But as I'm reading the question again, I think the second issue is when you actually prepare your balance sheet, could you have both? And yes, you still could have both, because you could have a bunch of contracts that once you net them are in a contract asset position. You could have a bunch of other contracts that once you net those are in a contract liability position. So you could have both on your balance sheet, but at each contract level, you have to net them under current 606. Hopefully that's what you were asking. Hopefully I answered it.
Thanks, Mike. Are there other questions that folks would like to address?
Jennifer, I could answer a couple on software. I'm going to kind of combine a couple of questions, I think, that are similar in effect, that there are questions about is the proposed ASU going to clarify which various costs that would be subject to capitalization, or would this deal with impairment or abandonment guidance of internal use software? So this proposed ASU only deals with the capitalization threshold for software. It does not deal with any other, like which cost should be capitalized. That is not expected to change, or it does not deal with impairment. Sort of the backside of this, it's just really when capitalization should begin. So that's hopefully that's helped clarify that.
Thank you. Okay, at this time, we can go ahead and close out this polling question and share the results. Okay. So with that, I am now going to turn it over to Lucas.
Thank you, Jennifer. And now I'm going to discuss derivative scope refinements, topic 815. This project came out of the June 2021 agenda consultation invitation and comment, in which stakeholders noted that there are difficulties with the scope and application of derivative guidance. As a result, the FASB chair added a research project to address the issues raised surrounding the scope of Topic 815, capturing contracts and arrangements where derivative accounting was not considered to be the most decision useful for investors. In December of 2023, the board decided to add the derivative scope refinements project to the technical agenda. Currently, under the derivatives guidance in Topic 815, entities must evaluate whether an arrangement as a whole or an embedded feature in that arrangement meet the definition of a derivative. Topic 815 outlines a 3-criteria model for determining if an arrangement falls under the derivative definition. To be considered a derivative, a financial instrument or contract must have the following 3 characteristics: an underlying and a notional or payment provision, little or no initial net investment, and finally, net settlement. Additionally, Topic 815 outlines a list of contracts that are not subject to derivative accounting, even if they meet the definition of a derivative. For example, this would be normal purchases and normal sales, leases, investments in life insurance. There are many. Stakeholders have questioned the usefulness of the information that is provided in the accounting for certain contracts that have entity-specific payment provisions as well. And on this current slide, you can see examples of this highlighted in red. Some stakeholders believe that in these instances, the accounting for arrangements as derivatives is not decision useful. To address these concerns, the FASB has issued and received comment letters on an exposure draft. The next step for the project is to begin board redeliberations. To dive into the proposed amendments, the exposure draft addressed 2 distinct issues, one being the scope of the derivatives guidance, and the second being the accounting for a share-based payment from a customer in a revenue contract. Beginning with the first issue on the scope of derivatives guidance, the board exposed a scope exception for non-exchange traded contracts with underlyings based on the operations or activities that are specific to one of the parties to the contract. This was in order to better align the accounting with the economics of these transactions. For example, if an entity issued a bond with interest determined based on hitting a certain emissions target, that would not be considered a derivative via the new scope exception because that emissions target is related to the entity's operations or activities. It is important to note that underlyings based on a market rate, price, or index, or the price or performance of a financial asset or liability would not be captured by the scope exception. Under current guidance, issues arise when a contract or an embedded feature in a contract have more than one underlying, and some, but not all of them, qualify for a derivative scope exception. In these scenarios, an entity must perform a predominant characteristics assessment, which is needed to determine whether the contract in its entirety qualifies for a scope exception or whether only part of that contract qualifies, in which case bifurcation would be required. Currently, the predominant characteristics assessment states that a contract is subject to derivative counting if all of its underlyings, considered in combination, behave in a manner that is highly correlated with the behavior of any of the component variables that do not qualify for a scope exception. Stakeholders noted that this assessment is very difficult to apply because of the correlation assessment, which causes diversity in practice. As a result, the board also decided to amend the predominant characteristics assessment and replace the correlation assessment with a fair value assessment. With the proposed amendments, an entity would assess how each underlying affects the fair value of the contract and then determine which underlying has the largest expected effect on changes in the fair value of the contract overall. The underlying that has the largest expected effect would be considered the predominant underlying. Whether that predominant underlying qualifies for a scope exception would then determine the contract's accounting treatment. That is, whether a scope exception can be applied to the contract as a whole or if bifurcation is necessary. For example, if a contract has multiple underlyings and one of them qualifies for the scope exception, and that's the one that drives the largest change in the fair value of the contract, the entire contract will qualify for the scope exception, regardless of the other underlyings. The scoped out underlying is considered predominant, and the whole contract would qualify for the scope exception. Moving on to the second issue addressed in the exposure draft, the board decided that an entity that receives a share-based payment from a customer in a revenue contract would apply the guidance in Topic 606 as opposed to Topic 815 or Topic 321, which are considered under current GAAP. This decision was based on practitioners' observations that there is a lack of clarity in GAAP on which area of guidance should first be considered to account for these. An entity that receives a share-based payment from a customer in a revenue contract would not apply the guidance in topic 815 or 321 unless and until the share-based payment is recognized under topic 606. I will now pass it back to Jennifer for a polling question.
Thank you, Lucas. Please launch polling question number 10. Webcast attendees, this is the last polling question that we have. So if you have not answered 8 of them yet, you'll definitely want to answer this one. It asks, which area of the webcast did you most benefit from learning about thus far? A, the FASB's current agenda. B, post-implementation review activities. C, private company council activities. D, not-for-profit advisory committee activities. E, technical agenda projects. F, other. The speakers, would you like to address any questions at this time?
Sure. Maybe Jennifer, I'll take one question with regards to our project on the accounting for government grants. And the question really, I think it comes down to why are we looking at a different model for business entities than what exists for non-for-profits? And I think that's a fair question, right? And I think this is something that was considered by the board during deliberations on this project. But I think we have a few key differences here, right? When we think about the difference between a business entity and a non-for-profit, right? A non-for-profit's core business model is to solicit contributions and get funding from third parties. And for government grants from a business entity perspective, it's a different model, right? They're not in the business of necessarily getting grants. And so we didn't think that necessarily the starting point needed to be the non-for-profit guidance because of those different business models between non-for-profits versus business entities. But then I think we also had some additional, things to consider from a business entity perspective, right? First of all, there was existing guidance, and as Jeff mentioned, right, more often than not, folks were following IAS 20 guidance, right, rather than the non-for-profit guidance. So I think when we think about this from an international perspective, right, would moving away from that kind of actually have some sort of divergence from international standards, but also thinking about it from just changes in practice, right? One of the things I think that's been really interesting with regards to this project is, this is kind of a continuation of we've been talking about government grants for a while from a FASB perspective. We actually issued some disclosures that were required for business entities for disclosing government grants in the past. And I think that provided investors with a lot of decision useful information. It gave them a lot of insight into it. But we still had that hole, that gap of we didn't have recognition and measurement guidance for government grants. So I do think when thinking about that, board members are going to weigh things differently. And right, one of the things I think board members considered here was we're not hearing from investors that they're necessarily looking for a different conclusion of how folks are accounting for government grants. They just wanted the transparency to understand, how they're doing that. And so there were certain board members who didn't think they wanted to significantly change the model. And that's where I think leveraging the guidance that's in IAS 20 is really helpful, because in many cases that's going to allow entities to be able to continue providing the information that they're doing in the manner that they're doing that their investors are comfortable with. But we've really been able to kind of plug that hole and gap with regards to now there will be guidance for recognition and measurement for government grants, and there won't be a need to analogize to guidance anymore, right? And so I do think that's going to reduce some of the diversity that's out there today, not just from the standpoint of reducing the IAS 20 versus the 958-605 kind of guidance, right? That diversity, but also within applying an analogy to IAS 20, I think now we're going to have clear guidance that's going to be applied by all business entities here that are applying US GAAP.
Thank you, Hillary. Okay, with that, we can close the polling question and share the results. Great. Looks like there are a lot of learning opportunities in different sections here in the webcast. So Lucas, back to you.
Yes, so I now want to bring your attention to the Codification Improvements Project. This is a standing project that the board conducts to make technical corrections, minor improvements, and clarifications to the codification. These amendments are not expected to have a significant effect on current accounting practice or result in significant costs to most entities. Although the Codification Improvements Project is not intended to have a significant impact on practice, of the 34 issues voted on at the September 18th board meeting, 10 of them pertain to not-for-profit entities. and therefore it is something that is important and useful to be aware of as this project goes through the exposure draft process. The exposure draft of the proposed accounting standards update is expected to be issued around the end of 2024 or early 2025 with a 90-day comment period. The 34 issues in the proposed accounting standards update encompass a wide range of topics in the codification, and I will briefly focus in on one particular issue that is meant to clarify the guidance related to not-for-profit entities and the accounting for certain receivables, and this is what Sue had alluded to earlier. Current guidance in topic 958 states that not-for-profit entities should account for receivables arising from exchange transactions due within 1 year at net realizable value. However, the amendments in the CECL accounting standards update issued in 2016 applies to all entities, including not-for-profits. Therefore, the codification improvements proposed amendments would resolve this inconsistency by amending that paragraph to refer to CECL for the accounting of receivables. We are not sure whether this would be a significant change, as we think it may not be very different in practice, and that is why we are highlighting it for stakeholders. I also want to remind you about the CECL practical expedient that Mike touched upon earlier. For many NFPs, that would potentially impact the accounting for these receivables, so it's good to keep an eye on that as well. And with that, I would now like to turn it over to Rose, who will be covering select FASB research agenda projects.
Thank you, Lucas. So we're going to start by going over 2 of our research projects, the first of which is accounting for and disclosure of intangibles. So we can proceed to the next slide. The FASB's current research project on intangibles was added in 2020 and has evolved as a result of feedback received from the 2021 agenda consultation. However, a project on intangibles has continued to be challenging, given that stakeholder views on intangibles continue to be diverse, including views about when an intangible should be capitalized as an asset and what decision useful intangible related information should be provided to investors. As a result, the FASB will be issuing an invitation to comment to gather feedback on potential intangibles projects. We can go to the next slide. The FASB has received feedback on intangibles in a variety of forms, whether through standard setting projects, research projects, or other ITCs. In response to the 2021 agenda consultation, feedback was mixed about the type of projects that should be pursued. The areas that respondents suggested that the FASB should focus on included the differences in the book value and market capitalization for companies who have internally developed intangibles compared to those that have acquired intangibles, the fact that there is no overarching framework to account for intangibles, and the level of information available for investors about internally developed intangibles and research and development. Respondents also had diverse opinions on whether an intangibles project should be focused on recognition and measurement or disclosures. So on the next slide, we see that currently there are several areas of gap that provide guidance for intangibles. When determining which guidance to apply, an entity evaluates the specific facts and circumstances and nature of the intangible. For example, the recognition and disclosure models vary depending on whether the intangible is acquired or internally developed. And looking at the next slide, the purpose of the ITC is to solicit broad stakeholder feedback on whether the board should pursue a project on intangibles. Specifically, the FASB would like to understand whether there is a pervasive need to improve GAAP related to the accounting for and disclosure of intangibles, what types or groups of intangibles the FASB should consider addressing, what potential solutions the FASB should consider in addressing intangibles, and the expected benefits and expected costs of those solutions, if accounting for intangibles should differ depending on how the intangible is obtained, and finally, what information about intangibles investors utilize or would utilize for their analyses, and how that information influences an investor's resource allocation decisions. So next, we're going to be discussing financial key performance indicators for business entities, another one of our research projects. On the next slide, we see that the June 2021 agenda consultation included questions about financial KPIs, including are there common financial KPIs that would provide decision useful information if defined by the FASB? And if defined, should disclosure of such financial KPIs be required or optional? The feedback was discussed by the board later that year. The feedback was diverse, with investors assigning a higher priority to this topic, while preparers assigned a lower priority. Some respondents noted that defining KPIs would provide a common starting point that could increase comparability. Others noted that management was best positioned to define financial KPIs. Additionally, certain respondents indicated that greater disaggregation of financial reporting information could address many of the relevant issues for this topic. For example, disaggregated information may benefit investors by providing more granular information about the source of common adjustments used to create financial KPIs. In 2022, the FASB chair added this project to the research agenda. The staff has continued to research this topic and performed outreach with different types of investors, including the FASB's Investor Advisory Committee. Since the 2021 agenda consultation, progress has been made on multiple projects related to disaggregated financial information, including, like we spoke about earlier, the disaggregation of income statement expenses and also segment reporting. An invitation to comment was issued last month with comments due in April 2025. We can proceed to the next slide. For purposes of the staff's research, a financial KPI is defined as any financial measure that is not presented in GAAP financials and is calculated or derived from the financial statements and/or underlying accounting records. Examples include return on assets, EBITDA, the current ratio, and free cash flow. This does not include financial statement performance measures, totals or subtotals directly presented in GAAP financials, or non-financial KPIs that use information outside of the accounting records. Items such as revenue, gross profit, operating cash flows, same-store sales, and number of subscribers are excluded from the scope of this project. We can proceed to the next slide. The objective of the invitation to comment is to explore the pervasiveness of perceived issues related to financial KPIs and whether technically feasible solutions exist. Responses to the ITC will help inform the board as it considers whether to add a project to its technical agenda, and if added, to determine the objective and scope. The FASB would like to understand how investors use financial KPIs, why preparers present financial KPIs, and if they are comparable to their peers, and preferences of investors and preparers for a potential standard-setting project on financial KPIs. With that, I will turn it back to Jennifer for some question and answer.
Thank you, Rose. We have about 5 or 6 minutes left in the webcast, and we've got a few more questions to answer, so I'll turn it over to some of the speakers to address those questions.
So I can go, Jennifer. One of the questions, it was an earlier question, can you provide an example of a standard that did not meet its objectives and what was the remedy? And I think that question was posed in the context of our post-implementation review efforts. And so the FASB has only issued one post-implementation review, and that's revenue. So I don't really have any examples of issuance of our reports other than revenue. Now, prior to that, there was a process undertaken by the Financial Accounting Foundation that did do some reports, and their efforts were slightly different just because of the way we do standard setting. We can actually, as we learn things, sort of react and respond in terms of being able to amend and update standards. And so oftentimes when we find that there's a problem with the way the standard's actually being implemented, or it's not clear, we can act immediately by either providing clarification through an accounting standard update or through educational efforts or what have you. So right now we're batting 1,000 because we've only issued one report. And then I'll answer one other question while I have the floor, I guess. How does the FASB view a principle-based approach versus a rules-based approach when considering what issues to tackle? Kind of a broad question, but you can see, like, when we've done some of the more comprehensive projects, we have employed more principles-based approach, particularly when we were working with the IASB. But I think it's really just facts and circumstances. And I always break down, when I think of a project or I think of an issue, people have heard me say this a million times, but it's sort of like, what is the problem we're trying to solve? And what is the potential solution to that problem? And so from that perspective, when we break down what the problem is, sometimes it may be something that where a principles-based solution is warranted. And in other instances, it may not be. It may be more narrow scoped. So I think sometimes, when you think about some of the guidance in the codification today, particularly as we get into like things like liabilities and equity or hedge accounting, there's a lot of rules there, and it makes it actually more complicated on a go-forward basis. So I would just say the answer to that is probably facts and circumstances.
Thank you, Sue. Mike, did you want to jump in there and answer a question?
Yeah, sure. There was a lot of questions on, I think, software as a service, or what we call SaaS, and whether the model 35040, I'm looking to the top right because that's where my Q&A is. So, in broad strokes, I think it's very confusing because of the title of software to be sold, leased, or marketed, which is subtopic 98520. That is meant for essentially older guidance. I think it was issued in the 80s when I was just a little boy. And that's where, if you know what Microsoft DOS is or Windows, you would go to a store and literally buy software. And that's the model that it relates to. And you would accrue or capitalize costs under that model when you reach technical feasibility. And then once you reach that, a lot of the costs that I think ended up being capitalized is like burning the stuff onto a CD, the boxes that you put the software in. Under a cloud or a SaaS arrangement now, at least in my personal experience, I've never seen this applied, because you would still apply this model if you meet two conditions, and that's if the customer can take possession of the software from the hosted site without significant penalty, and they are able to actually run that on their own servers or their own computers. I just think that that's counterintuitive to the SaaS model, which relies on recurring revenue, so they don't want to lose that. So I don't think that's pretty much applied today. So if you are a SaaS platform, I would imagine that most of you will still be applying 35040, which is what was discussed today. And that's considered to be internally developed software when you would capitalize that.
Thanks, Mike. We've got time for maybe one or two more questions or remarks. Are there other questions that folks would like to address?
And maybe, Jennifer, maybe not a question as much as just a remark of, just we've had so much great interaction today through the webcast, right? Seeing the different questions that are coming in. And I think a lot of the questions that are being asked, some of them are very specific to facts and circumstances, so we're not necessarily able to answer those here today on the webcast, but certainly will be shared with our project teams that can get back in touch with you with regards to kind of helping think through those issues. But I think a lot of the questions that are coming up, right, these are, we have those exposure drafts out right now, and we're looking for your comments on them. So I would say also encourage everyone who is kind of hearing about these projects for the first time, or really starting to really understand the decisions that were made by the board. This is exactly the type of feedback that we're looking at, right? To make sure that when we go ahead and go through redeliberations, that we have the benefit of all of your feedback, right? We always like to say we like to be in a no surprises business here at the FASB. And I think today you've really helped us to identify a few areas that we're going to need to, think about, in the areas where there might be questions that we need to make sure are clear within the guidance. So certainly I've been super impressed with the interaction here today, and I really encourage it, whether it's here on the webcast, whether it's providing feedback on our exposure drafts or on our invitations to comment. So certainly that is just an open call for your feedback to help us make sure that, the standards we put out are the quality of those are directly attributable to the quality of the feedback that we get. And I just feel really happy that we're getting great quality feedback through this channel as well.
Thank you, Hillary. So with that, on behalf of the FASB and the PCC, we'd like to thank you for your participation today. Happy holidays, and that concludes today's webcast.